I want you to imagine something. It's January 12th, 2026, and a $7 gap has just opened up between the price of silver in New York and in Shanghai. Now, this isn't just some minor pricing difference. In a healthy, connected market, this is a mathematical impossibility. It's a fissure in the global financial system. This gap is a signal. And the real question is, what is it telling us? Well, in this explainer, we are going to dissect that signal and figure out exactly what it means for the real value of your money.
So let's be crystal clear about this from the start. What we're talking about is not your normal everyday market volatility. No, this is a fundamental break. It's a giant flashing sign that the paper contracts being traded in the West are becoming dangerously, totally disconnected from the actual physical metal being delivered in the East. And what that really suggests is that the trust, the very foundation of the entire pricing mechanism, is starting to shatter.
Welcome to Bullion Signal. Our entire mission here is to help you filter out all that chaotic noise in global finance so you can focus on the clear signals that actually matter. You know, it's why our Bullion Signal community is growing every single day. If you appreciate this kind of clear-headed analysis, just take a second to subscribe. That way you won't miss our updates as this whole situation continues to unfold. Okay, here's our roadmap for today. First, we're going to dissect that crack in the system. Then, we'll zoom out and look at the bigger macro picture. After that, we'll break down the 4 key forces that are causing this whole thing to break down. And we'll finish up by giving you a hidden signal to watch for. So, let's get started. All right, let's begin with the event itself. While traders in New York saw silver touch $84 an ounce, over in Shanghai, the Gold Exchange fixed the price for physical delivery at over $91. That $7 difference, that's the crack we're here to investigate. It's an arbitrage gap so massive, it shouldn't exist for more than a few minutes. The fact that it's sticking around, well, that tells us everything we need to know. Let's just walk through the morning's timeline. After a tiny dip right at the open, the price didn't just climb, it launched. And I want you to look really closely at that 8:30 a.m. spike. A gradual climb, that signals normal buying. But a vertical move like this, that's not buying, that's panic. It screams that a major player, probably someone shorting the market, was forced to cover their position right then at any price, just to avoid getting completely wiped out. This is what pure desperation looks like on a chart. You know, none of this is happening in a vacuum. It's all playing out against a backdrop of deeply unstable global finance. We've got persistent inflation eating away at savings, sovereign debt that's just ballooning to unsustainable levels, and of course, rising geopolitical tensions creating all kinds of uncertainty. In an environment like this, a global scramble for real tangible assets has already begun. It's like a high-stakes game of musical chairs, and the big players are starting to realize there just aren't enough chairs or physical assets for everybody.
So here's the crucial mind shift. The way to think about this is not, wow, silver is getting expensive. The correct way to see it is that the dollar is getting weaker. Every single tick up on that silver chart is just a measurement of the dollar's purchasing power evaporating into thin air. That $7 gap between New York and Shanghai, it isn't just about silver. It's a direct challenge to the credibility of the entire Western pricing mechanism. The East is signaling loud and clear that they no longer trust the West's paper price.
All right, this brings us to the real heart of our analysis today. To truly get what's happening, we need to peel back the layers of the market. We've identified 4 distinct, really powerful forces that are all converging at the same time to create this fracture. And by looking at each one, we can go from just watching the chaos to actually understanding the mechanics behind it.
So the first force is this massive chasm that's opening up between the price you see on a screen and the price to actually get the metal in your hand. The COMEX might say $82, but if you try to buy a physical coin, dealers are charging premiums of $25 or more on top of that. Some have just stopped selling entirely.
This isn't just a supply chain hiccup, this is what a real-world physical default looks like in its early stages. And this just lays bare the two-tiered market we're all living in now. On one side, you've got the paper market, where big institutions trade digital contracts that represent silver. But on the other side, you have the street market, where industrial and retail buyers need actual physical atoms. The paper market sets that famous spot price. But the market for the real atoms, it's becoming illiquid. It's reflecting a true physical demand that is completely breaking away from the paper promises. Okay, the second force is something most people never even see, and it's driven by corporate panic. I want you to imagine you're a procurement officer at a company like Samsung or Tesla. Your number one fear isn't the price of silver, it's your entire production line grinding to a dead stop because you can't get it. For these companies, silver isn't a luxury, it's absolutely essential. And this fear is forcing them to create what we call ghost supply. Let's make this really concrete. That procurement officer, she sees Shanghai paying this huge premium, and she understands immediately that all the available metal is flowing east. Her job is to keep the assembly lines running no matter what. So what does she do? She gets on the phone to mines in Mexico or Peru directly, and she offers to pay above the COMEX price for immediate delivery. She becomes a price-insensitive buyer, and in doing so, drains massive amounts of physical supply before it can ever even hit a public exchange. Let's just pause here for a second. This whole dynamic isn't unique to silver. It's part of a much broader shift from a just-in-time to a just-in-case global economy. And we're curious about what you are seeing out there. Down in the comments, let us know where else you're seeing signs of this kind of supply chain panic, this strategic hoarding. It could be in commodities, electronics, even food.
The third force is just a matter of hard, physical reality. Look, even if silver goes to $200 an ounce tomorrow, you cannot magically create more of it. Mine supply has been basically flat for years. But more importantly, the world's refineries, the places that turn raw ore into investment-grade bars, they're already running 24/7, and they're reportedly booked solid for more than 6 months out. Price can signal demand, sure, but it absolutely cannot overcome the physical speed limit of production.
And this bottleneck leads to a really key technical signal. It's called backwardation. In simple terms, all it means is that the market is willing to pay a premium to have the metal right now instead of waiting for delivery later. But what backwardation really signifies is what's important. It is the market screaming at the top of its lungs that it has lost all trust in the just-in-time delivery system. The fear that the metal won't be there next month is so great that buyers will pay more just to get their hands on it today. And now we get to the final force. The public is waking up. That dramatic price move we saw, it was like a flare gun fired in the middle of the night. It grabbed everyone's attention. And the psychology is shifting fast. It's going from, is silver a good investment, to, how do I get some before it's all gone? This creates a new, massive wave of money flooding into what is, in reality, a tiny market for physical coins and bars. This retail tsunami adds a powerful and often very unpredictable new source of demand.
And this isn't just a feeling. We can see it right in the data. Over the weekend, when this price gap emerged, global search volume for the phrase "how to buy silver" shot up by more than 300%. This just shows you how quickly the narrative can shift and capture the public's imagination. And unlike institutional money, this retail demand is often driven by pure emotion and a fear of missing out, which makes it a particularly potent force in a market that's already under severe physical strain.
So as we're seeing these early signs of a potential mania phase, it's a really good time to think about investor behavior. So we'd like to ask you, what do you believe is the single biggest mistake investors tend to make when a market gets into this kind of frenzy? Share your thoughts down in the comments. Your insights will be a great primer for part 2 of this series, where we're going to focus heavily on risk management and strategy. Now, we absolutely have to issue a crucial warning here about the ETF trap. As all this new retail interest floods in, many people will go buy paper silver ETFs thinking they own the metal. They don't. In the middle of a physical shortage, buying a paper ETF is like buying a ticket to a concert after the venue is already burned to the ground. You're basically handing your cash to the very institutions that are short the market, and you could be left holding a broken promise. The old saying has never been truer. If you can't hold it, you don't own it. Okay, so we've looked at the 4 forces that are breaking this market. Let's transition to the key strategic takeaway for part 1. We want to give you a simple, clear framework for observation. Now, this isn't financial advice. Think of it as a tool, a lens that you can use to personally monitor this situation and cut through all the noise to see the real underlying signals for yourself.
Here is the framework. It's a simple if-then model. Take a look at the first row. If you see that East-West premium holding steady are getting even wider, then you should watch for an accelerated drain on the COMEX inventories. The risk you're considering there is a rising chance of delivery defaults. Now the second row. If you see major bullion dealers halting their online sales, then watch for a big spike in ETF outflows as people scramble for physical. This points to the growing risk of a complete decoupling between the paper price and the physical price.
So that brings us to the end of our diagnosis here in part 1. We've established that the $7 price gap isn't the problem itself, it's a symptom. It's a symptom of these 4 powerful forces: the physical disconnect, the industrial scramble, supply bottlenecks, and the retail awakening, all combining to break the market. We've diagnosed the why. So in part 2, we're going to shift our focus to the crucial question of what now?
In our very next explainer, we're going to equip you with an investor playbook. We'll analyze the reversion of the gold to silver ratio. We will discuss strategies for navigating the insane volatility that is sure to come, and we'll explore the critical concept of an exit strategy, which is not about selling for dollars, but about trading ounces for real income-producing assets. We are going to cover what it takes to survive the great repricing. Make sure you're subscribed so you don't miss it. So we'll leave you with our golden nugget for today. The market has stopped pricing in future risk. It has begun pricing in the current, sudden, and very real absence of physical supply. The coming weeks are going to be incredibly volatile. The paper market will be used to try and shake you out. Watch the physical flows, not the noise. And please remember, this content is for informational purposes only and does not constitute financial advice. Always do your own research.